in trading those commodities? What are the timings of commodity exchange across the globe? How do you study commodities? What are the different ways of understanding this particular asset class? What are the participants, products, circuit limits, economic hitting indicators, some bit of basics of precious metals and energy. So that is how the webinar would possibly be structured for next half an hour or so. So we'll proceed now. Okay, the first and the foremost thing is to understand that commodities is an asset class which has to be looked in the context in comparison to all other asset classes. As you can see in this screen, asset class can be classified into almost five types of asset class. The first is real cash, which is liquidity. Second is equity, which is nothing but the ownership. The third is fixed income, which is in the form of recurring deposits and fixed deposit. The fourth is physical possession of real estate. And the fifth and the last but not the least is commodities, which clearly means ownership of goods. To put this in context, commodities is mostly understood by the individuals as an asset class which is just for trading purposes. However, the existence of this asset class is purely the sole reasons for the existence of equities. Because without commodities, you really cannot have shares and stocks of those companies that are listed on the exchanges globally. Hence, the basic underlying behind the global trade is that commodities are there in existence. Countries are interdependent on each other purely on the basis of this asset. So, just to tell you, one key takeaway from this particular slide is that commodities is an asset class which you really cannot ignore. You can be in any part of the globe. You have to understand this particular asset. For simple classification, for those who really do not understand commodities, commodities can be bifurcated into two. One is non-agri commodities or non-agriculture commodities, to be very precise, and agriculture commodities. Non-agriculture commodities can be classified into three further sectors. One is precious metals, second is base metals, third is energy, while agri commodities can be classified into oil and oilseeds, cereals and pulses, spices and guar complex. Precious metals, purely as everybody knows, gold and silver as an asset class which everybody needs to have in the part of their portfolio, whether you be a retail investor, whether you be a big investor, or whether you be a fund investor globally. As far as base metals is concerned, lead, zinc, copper, aluminum, nickel are the commodities that are listed on the exchanges in domestic as well as international circuits. While as far as energy is concerned, crude oil and natural gas are two commodities which are traded in the domestic exchange as well as on the international exchange. This classification is purely done on the basis, if you compare it with equities, in equities you have IT, you have banking, you have pharma, you have a host of other sectors in which a particular stock is listed. Into the similar way, you have commodities which can simply be classified into two sectors. One is non-agriculture commodities, which clearly the meaning says non-agriculture. The second part of the equation is agriculture commodities, which is purely dependent on how agriculture commodities are traded across the globe globally. Why commodities? I think the basic context here is why do you need to understand commodities as an asset class? If you compare it with equities, there are almost 7,000 shares or stocks that are listed on the exchange. In comparison to this, you have almost 15 to 20 commodities that are listed on the commodity exchange. In that case, it is really difficult to possibly choose from a 7,000 stocks listed on the exchange if you're trading equities, and to take out one stock which would possibly give you good return. In comparison to that, you have 15 commodities that are more liquid in domestic as well as international circuit. While in that 15 commodities, you have gold, silver, crude, copper as one of the most liquid commodities that is traded in the domestic as well as international exchanges. So in that case, the problem of choice gets eliminated if you are trading commodities. So this is one of the reasons why you need to understand commodities first. Second, Existence of stocks and shares, as I said in the previous slide, that it is because of trade, the export import of commodities globally, that has resulted into interdependence of countries for different commodities, which results in global trade. So if there is no commodities, there are no further chain reactions or cycle that results into further bifurcation of any asset class. Uh, and the best thing about commodities is it is globally connected. You really cannot have a manipulation in this particular asset class. And the next best possible option why you need to understand commodities is because it is open 24 hours a day. Unlike equities, which is almost open 6 to 7 hours a day, which means you can just take benefit out of say investing or trading in equities. It just has 6 to 7 hours. Vis-a-vis commodity, it is 24 hours a day. Not only in India, but also when you see it in the global context. I will tell you how commodities are traded 24 hours a day globally. But before that, we need to understand what are the exchanges that are involved in commodity trading. The domestic exchanges can be classified into multi-commodity exchange, in which purely most of the non-agriculture commodities are traded, although it has some commodities which trades agriculture commodities. National Commodities and Derivatives Exchange, which is nothing but it has all the agriculture commodities as a main component. You have BSE NSE, which is the recent entrant in the commodities market. So these are on the domestic exchanges side. Well, as far as international exchange is concerned, you have NYMEX, which is one of the biggest exchange in the US, which is New York Mercantile Exchange. You have ICX, which is Intercontinental Exchange. You have COMEX, which is the Commodity Mercantile Exchange. You have biggest exchange in China, which is Shanghai Futures Exchange. These are the exchanges that have the commodities that I said: gold, silver, crude, copper, lead, zinc, aluminium, nickel, that are traded across the exchanges in the international arena as well as in the domestic exchanges. This is one of the important slides that one needs to understand. In order to have an understanding of any asset class, it is obvious and assumption, and it is necessary that you need to understand which markets open first. And in this particular scenario, the logic says that commodity market runs 24 hours a day, which means 3:30 a.m. Indian standard timing. As you can see on the right hand screen, New Zealand Stock Exchange is the first markets to start. And if you see in the slide at the last line, it is 2:30 a.m. Indian standard timing, the
Hi,
markets end.
Prathamesh.
So starting from
Prathamesh
New Zealand, which is the
Mallya.
first market to open, followed by Hong Kong, which is the second best liquid markets that open in Asia, followed by National Stock Exchange, which is in India, then followed by Europe, which is London
Prathamesh,
Stock Exchange,
sorry to
and then
interrupt
followed
you.
by Toronto, and then followed by New York. So these are all the important stock exchanges that open and close as per the Indian standard timings. And the reason why you need to understand timings and openings of commodity exchanges is purely because of the volatility that is involved in it. If you don't know the timings of different markets, it is difficult to understand commodities. Hence, the basic premise for understanding commodities is first and foremost get your basics right. You need to understand which markets open first, which markets open last, what is the time you have maximum volatility, and the maximum volatility in commodity markets happens in the time when New York Stock Exchange open. This is all about equities. Commodity markets in that particular country starts 1 hour later as compared to equities, and they run 24 hours a day when you compare it to Indian standard timings, and that is how the importance of timings come into picture. Just to put things in context, on the right hand side on the corner, there's a New Zealand, which is the first market to open, followed by Japan, which is in the middle, followed by Australia, followed by China, followed by India, and followed by Europe, and at last Brazil, US, and Canada are the last markets to open. And the logic clearly states that sun rises in the east and sets in the west. And according to a geographical understanding, if you haven't really looked at the map before, for basic and pure understanding of commodities, it is really necessary that you need to understand which countries are located where in order to understand the risk arising out of that particular commodity. For instance, if you're talking about oil, it is produced mostly in Middle East and Africa, which means you have to understand any risk arising out of that particular country, say Saudi Arabia, which is there in the middle, Saudi Arabia, and all the Middle East countries. If there is any disturbance with regards to geopolitical crisis, this is what you need to know, where the countries are and what their timing, what are their market timings, and hence the importance of timings comes into picture. The key takeaway from this particular map is it is a reference point. You need to know where your risk is, what all is happening in various parts of the world. It is a representation of all the continents and countries in one piece. You really need to know where are the countries, what are the timings. It really tells you about the depth and the shallowness of your knowledge with regards to the geographical locations involved in understanding of commodities. So next time when you visit a map, have in your free time, look at it from a strategic perspective. What is the risk point? Why you need to understand a particular country, and why you need to understand why you need to understand the risk arising out of that particular country.
Prathamesh, am I audible? Sorry to interrupt you. Hello. Hi, Prathamesh.
Uh, I hope I am able to make justice to the participants who are there in this particular webinar with whatever basics I can tell you. And if you can hear me loud and clear, just type yes for once, because
So,
there is some internet connectivity that
yeah,
is there. Yes,
we
so
there's a
can you
status
guys see
that
the PPT? Yes, okay, I can see. Yes, your presentation is not visible. Okay, it is because I have resume your presentation. Resume present. Yes. Now it is visible, right? Okay, I'll resume. Uh, And in order to put this in context from a domestic commodity exchange perspective, MCX and NCDX are two main primary commodity exchanges in India, which has good amount of liquidity, and hence this is the platform where you need to know what are the timings are. And just there's a small error. Monday to Friday, 9 a.m. to 5 p.m. Is for all the agro-based commodities, while for all the non-agro commodities, it is 9 a.m. to 11:30 p.m., 11:55 p.m. So it starts at 9 p.m. There's a change very recently that has happened. You can see there is 10 a.m. written, but it is 9 a.m. It starts with equities. The commodity market starts with equities. How to study commodities? See, if you need to understand any asset class, there are two ways of doing it. One is fundamental, second is technical. It is for this obvious reasons that you need to have an understanding of fundamental perspective, and you need to have a technical perspective if you need to have a clear understanding of where the asset classes are headed. So this is just to give you a hint and an idea that if you need to understand commodities as an asset class, there are two ways of doing it. One is the fundamental way, which you are studying now, which is nothing but basic of commodities, and the technical representation is by studying charts, wherein you have different studies which tells you where the prices are headed. This is one of the key assumptions on the basis how commodity market works. Since commodity is a physical product, there is a spot market for this particular asset class, unlike equities, wherein the delivery happens in your demat account. Like other asset class, which is equity, you have spot markets available in case of commodities, you have futures market available in case of commodities, and you have options, which has also been introduced as an asset class from the basis of hedging and insurance perspective. So if you need to understand commodities, first and foremost, you need to have an understanding of geographical locations. You need to have an understanding where that commodity is produced, where that commodity is consumed, which commodity is traded globally, what is the kind of liquidity that happens in that particular commodity, and what are the products that are available in the domestic platform in order to make, in order to take the benefit out of the commodity as an asset class. This screen will tell you if you have some basic of commodities and if you know how to trade in commodities. This is just to put in trade. For instance, if you're trading in copper and there's a 1 rupee uptick or downtick in copper, it will give you a profit or loss of 2,500 rupees. Similarly, it can be seen for aluminium, wherein any 1 rupee up or down would give you a profit or loss of 5,000 rupees, as you can see on this particular table. The next important thing that one needs to understand while understanding commodities is how much amount do one needs to put in order to trade one lot of any commodity. For instance, you take example of copper. The size of the contract, as usual, the futures have contract specifications, is 2,500 kg. The price code that is there listed as 500 per kg is what you can see on the screen, and the size of the contract is nothing but the contract, the 2,500 kgs, which is the lot size multiplied by the price code, which will give you the size of the contract. And once you have the size of that contract, the margins to trade that commodity varies from 5% to 10% of the contract size. In this case, we assume that you have to pay 10% of 12,50,000 in order to trade one lot copper, and that is what the minimum amount is required in order to trade copper. But there are other options as well in order to trade commodities. This is just to tell you example that if you need to trade in commodities, you need to have certain amount of money in order to proceed further. This is also one of the important understandings of commodity markets. If you don't know what are the circuit limits in commodity trading, you will go for a toss. For instance, if you don't know that any commodity, whether it goes up or goes down, there are circuit limits. Similarly, that are there in equities. In case of gold, for example, if price limit on the upside or the downside reaches 3%, limit is breached, the relaxation of the price move further upside or further downside would be capped at 6%. Even if it goes beyond 6% up or down, there would be no cooling period in the trade. Once the 6% limit is breached, then there is a cooling off period of 15 minutes, and then the price limit will be relaxed up to 9%. Once it goes beyond 9%, you have to take regulatory approval for further trading, and that is how the trading resumes in commodity market. So this is from a risk perspective. If you have exposure or if you trade any commodity, you purely need to understand it from a risk perspective, and you need to know that if a certain commodity goes up or down, it has certain caps, and that caps need to be adhered to. There are different caps for different commodities. This was just to give you an example that gold has circuit limit, which starts from 3%, followed by 6%, and then relaxed up to 9%. So this is very important part of commodity trading. Circuit limits has to be understood for all the commodities under consideration if you desire to trade in commodities. This is purely for those who have gained some understanding of commodities and they want to take it further. And before they need to take it further, there are some indicators which tells you about the status of that particular country. For instance, a GDP from any country, whether it be US, whether it be China, whether it be Euro or India, it clearly is a representation of a single number which tells you how the global economic situation is or how the situation of that economy is. Hence, this is a figure which needs to have a close watch if you are trading or if you want to put your money in understanding commodities. The second indicator that one really needs to have a keen eye for is a central bank meeting. The central bank are one of the experts in this particular field, wherein if anything happens in any part of the global economy, central banks are the first ones to come in, because these guys are the first ones to revive the global economy. As you can see in the current situation of the pandemic, central banks have come to the fore. They have pumped in enormous amount of liquidity, unprecedented amount of liquidity, in order to boost global economy back on track. Similarly, you have manufacturing index. It clearly tells you about the manufacturing activity that is happening in any country. Consumer confidence is one important indicator released in the US, which tells you consumer confidence is a number which represents 70% of the US economy. And we are talking most about US economy is because US is one of the primary producers and consumers of all the commodities that are produced. And the second best important thing of understanding commodities is the global trade that happens is built in dollars. And dollar being a reserve currency in the US, any economic indicator released from the US has to be there too. Okay, this is for those who just have an understanding that gold is a commodity, it is an asset which is produced globally, and the left hand pie chart tells you producers according to the size of production that particular country has. Just to tell you the basic that on an average, gold production across the globe annually stands at 4,000 tons. Now, on the left hand side of the graph, 11% of 4,000 tons comes to around 440 tons. So, which means out of 4,000 tons that is produced globally, almost 400 to 500 tons of gold is produced in China itself, followed by Russia, followed by Australia, US, Canada, Peru, so on and so forth. Similarly, on the right hand side, the gold demand story is nothing but clear understanding of what individuals across the globe put their investment into. The most part of the gold produced goes into making of jewelry. As you can see on the right hand side, almost 50% of the gold that is produced globally goes into making of jewelry, followed by a biggest share of bars and coins, followed by central banks portfolio diversification tool, which means gold as an asset class is used majorly for the purpose of jewelry. Although in this pandemic, the physical demand has really dried up across the globe, the liquidity push that has been done by the central banks has led to a drastic rise in the price of gold in 2020. It has almost given double-digit returns of 30% till date, and we continue to see further advancement as far as the situation goes. Market remains uncertain. You have U.S. elections in the corner. November 3 is where the U.S. election comes in, which is where the risk point is. This is for your information to tell you that globally these are the mines, gold mines that produce on an average most of the gold that is produced. You can see this is a commodity which is spread globally. It is mined in Australia, it is mined in Russia, it is mined in Canada, it is mined in US, it is mined in South Africa, it is mined in China. So gold is a commodity which is there available across the globe, although a lot of research goes into extracting and mining of this particular commodity. When you are in India, there are 3 to 4 options if you want to put your money in gold. As far as Indians are concerned, the physical form of jewelry is one of the most desirable ways that Indians could invest in as far as gold is concerned, followed by bars and coins. However, taking into consideration the pandemic, the gold accumulation plans, which is a part of say any digital platform, you have Google Pay, Paytm, Phone Pay. These digital platforms give you an option of accumulating gold starting from 1 gram and there is some limit which you can accumulate gold. Once you accumulate say 10 grams, you can take delivery of this particular commodity. And the certification and is being done by MMTC PAM, which is one of the biggest refiners not only in India but in a global scenario. The third option that if you need to invest in gold would be in the form of sovereign gold bonds. Sovereign gold bonds are a good option if you want to remain invested in gold for a longer period of time. The biggest advantage of this particular option is that it is backed by government of India. It is an investment purely from a longer term perspective. It has a tenure of 8 years with a lock-in of 5 years. Although these bonds are traded in the secondary market, they have less liquidity, but this is surely a good option for Indians who want to remain invested in gold for a longer period of time. The next biggest option as far as gold is concerned is exchange traded funds. Although this option is not so suitable logically in India, this is one of the best available options globally as far as liquidity is concerned, and this is one of the most liquid ways in the international circuits, international scenario, when ETFs as one of the best ways to invest in gold. If you don't understand anything and if you want to take the benefit out of volatility that happens in gold prices in the domestic market, I think that the trading in gold futures and options is one of the best ways to maximize profit potential if you really want to take the benefit out of price volatility in trading this gold and silver as a product. Uh, Vis-a-vis gold, silver market is huge in terms of production. Just to give you a perspective, 27,000 tons of silver is mined globally. One of the most important producers of silver is Mexico, followed by Peru, followed by China, Russia, Chile, Bolivia, Poland, Australia, and at last US. So what I want to tell you and bring to your notice is that the understanding of commodities is a pure understanding of geographical location of countries and the commodity that is produced in that particular country. If you don't know all the information, the risk perspective remains open for you if you are trading that particular commodity. Again, the second part is if you really want to buy silver in India, there are just two options. Either you buy a silver jewelry or an ornament, or you remain invested in coins and bars and sell it once price reaches your desired price points. So these are the two ways wherein you can remain invested in silver as far as this particular asset class is concerned. Crude oil, this is one of the most important benchmarks of the global economy, and this really tells you how a global economy is faring in terms of the growth. As most of the people. Yeah, you guys cannot see my presentation. Is that the case? I don't know. Can you see my presentation? Not now. Can you see my presentation now? Okay. Okay, I'll continue. I can see a lot of yes. The next important commodity that I'm talking about is oil. Oil is one of the important commodities globally. I think almost 100 million barrels per day of oil is produced globally. Because of the pandemic, almost 30% of the demand destruction has happened. As you can see, OPEC is one of the biggest countries. Stands for Organization for Petroleum Exporting Nations, in which Saudi Arabia is one of the important producers of oil, followed by Russia, followed by US. When you put all these countries together, almost 60% of the global oil production is produced by three countries, which means the risk perspective remains open. If you understand that OPEC is a nation, if you need to know that OPEC is a country, OPEC is a cartel which has almost 13 countries producing almost around 35 million barrels per day of oil. You need to know that Russia is a country which produces almost 12 million barrels per day of oil, similarly followed by US, and that is where the risk points are. This is just to give you a perspective that 100 million barrels per day of oil is produced globally, out of which 60% is produced by these three nations put together. This is again some perspective with regards to global growth. 2020, as you can see, the global growth has gone for a toss because of the pandemic. Minus 4.1% is what the global economy will grow in 2020, which clearly says that global growth is in a negative territory and it is in a recession. However, not all is bad as far as 2021 is concerned. Global growth might resume its trajectory, all the economies might possibly open up, and you can see 2021 growth possibly moving higher towards 4.7% as far as 21 is concerned. So there are some green shoots of recovery, but not in 2020, but in 2021. Natural gas. This is also one of the important commodities that one needs to understand. You can see on the left hand side of the map that almost everywhere in the US, this is a commodity which is mainly produced in US, traded in US, and similarly it is traded on our domestic exchange, which is MCX. This is a commodity which is amply available across US. This commodity is used in generation of electricity, and which is nothing because US is a cold country. It is used for cooling as well as heating purpose. And because it is used for generation of electricity, it is one of the important commodities that is listed on US stock exchanges, and similarly it is listed on the domestic stock exchange. But this is just for the information that tell you that natural gas is a commodity which is abundantly available in US, and it is one of the important commodities that is traded not only on the US exchanges but globally, and hence this commodity is of utmost importance. These are some of the websites for further learnings for the participants. You can go through this particular sites. It consists of a mix of agriculture as well as non-agriculture commodities. There is certain sites which is a reference site for aluminum as well as zinc. And just I'll sum it up for the 2 minutes. The key takeaway from this presentation would be global market timings. I think if you know the timings, the risk associated with your exposure, you might reduce it down. If there's a gap up and gap down opening, you need to know what are the country timings. If you need to, you need to know the understanding of global economy is a key ingredient to understand commodities. Geographical locations of the country also have a good importance in understanding of commodities. Since gold, silver, crude, and copper are four important commodities that are traded, I think you really need to know who are the producing countries, who are the consumption side, where is crude oil produced, and finally, last but not the least, the global growth, which is almost for a toss in 2020. Recession is there. 2021 might have a good beginning. Thank you very much for your patience to listen to me, and we will take questions from the participants. I hope I was able to make justice to whatever I said with regards to basic of commodities. We will further tune in with further advancement of commodities. If you have questions, we can proceed with questions. What is REIT? REIT is nothing but real estate investment trusts. It is a form of you. If you need to invest in real estate, it is one of the ways you can possibly move into real estate, but it is not so liquid. What is the buy range for commodity? Sir, just to tell you, there are 15 commodities listed, out of which 4 commodities are most liquid, and you need to know the price of that commodity. And as I explained in my previous slide, that there are circuit limits for commodities. And for instance, if it is gold, if it the 50,000 is the price, and if it goes say 3% up, the trading will be stopped for 5 minutes and then it resumes again. Similarly, if it goes on the downside, the same holds true. What is margins and lot margins? If you trade in equities futures, you need to understand that if you need to have exposure in one lot of any equity futures, you need to keep certain percent of margin. In similar manner, if you need to trade or say take exposure in commodities, you really need to give a certain amount if you need to have exposure in the commodity. And as I explained in my slide, it was say copper, which almost 1,25,000 is required if you need to trade in copper. So that is how the margins and the lot margins arrive at. Can I hold commodity for 4 5 years? I hold for equity. No, sir. 4 5 years is really a long time as far as commodity is concerned. But yes, if you have a business with regards to commodities, for instance, you own a jewelry shop and you have an exposure in the spot market. The best way to protect your price risk is to come on the commodity exchange in order to hedge your price risk, and that is where the consideration of hedger, speculator, and arbitrator comes into picture. In case of lots, it is limited to margin money or go beyond that based on the lot. Sir, as I explained, commodities market circuit limits has to be understood, and this was out of that context that if it goes 3%, if you don't have money in your margin account, the positions will automatically get cut. So in that way, you are exposed to the entire margin money in the first instance. So you need to prop it up with further money. So it goes the same with equities as well. Which is the best investment, Brent and WTI? So WTI is the most liquid as far as trading is concerned, while Brent is the most liquid in the physical market, which means Brent is an oil which is produced in most of Europe and it is consumed by most of Europe and Asia. Hence, Brent is a widely used oil, while WTI oil is a West Texas intermediate oil, which is mainly produced and traded in US. And accordingly, the commodities that are listed on the exchange is a pure representation of commodities that are listed on the US exchange. What is the lot size of gold and silver for investment purpose? The lot size, as far as gold is concerned, I think 50,000 is the price of the commodity. 1,000 grams or say 1 kg is the lot size of the commodity. That is the contract size for the commodity. And assuming 10% on the total contract size, I think it comes to around 5 lakh. So 5 lakh is the minimum margin if you're trading in gold and if you're carrying forward the position. Maximum time to hold it. So if you really want to invest in gold for a longer period of time, I think it is better to put your money in sovereign gold bonds, which is one of the important options given by government of India for people who want to remain invested in gold for possibly longer period of time. Should I trade online in commodities like securities? Yes, sir. Commodities trading gives you n number of options, and you can benefit out of price volatility as far as commodity trading is concerned. How I get position of commodities. This is possibly the advanced side of commodities, wherein we would possibly have second session of how the delivery of commodities comes into picture. What are the risks associated with it? Agri commodity and how and where to access charts. Angel has a good platform as far as charts is concerned. So possibly you can get in touch base with our advisors, and you'll have a follow-up mail after this, and that is where you can have access to all the charts. you really cannot put money in commodities without having margin. You need to have certain set of money in order to put your money in commodities. And not just one book really cannot suffice to learn it. It is a different accumulation of different sites, different learnings, different countries, different geographical locations, which is really not accumulated in one book. If you need to access charts free, I think investing.com is one of the good options that is there available to all the investors, whether you are in any part of the globe. So investing.com, investing.com, investing.com is one of the options that is there as a free source. Yes, Angel provides calls on commodity market. We have our advisory desk who take care of commodities. Research calls is given to our clients, and that is where you can make money in commodities. Minimum amount of money required to enter commodity market. I think minimum you should have at least 50,000 in your pocket if you really need to take exposure in commodities.